Water and Light Commission, August 11th, 2020. It is 9:13, and so I will call our meeting to order. And Trina, if you do a roll call.
Mayor Hill.
Here.
Commissioner Tankersley.
Finally here.
Commissioner Gormley.
Here.
Commissioner Fuchs.
Here.
Commissioner Christensen.
Here.
Thank you, Trina. This morning we have one item of new business, and it's a work session regarding the extension policy and extension agreement. And, much effort and information has been sent out to us, and so I'm just going to turn the work session over to John or Sam, and they can set the tone, and then we can have our discussion.
You want to start, Sam?
Sure. What I'm going to be looking at, you have your meeting packet, and I'm actually got that open on my screen.
Thomas? That's Margot. That wasn't me. That was Margot.
And so this, the discussion we're going to have today, we're really, I guess, in talking with John about this and how we'd approach it, our hope really is to have a discussion sort of about the broad issues. We're not really intending this to be a drafting session, but rather talk about some of the bigger issues that we've struggled with in drafting the document or documents. And we thought about this and how we might approach it. And we first thought that it might be a good idea for us to talk about the history of the extension agreements and the extension policies. From that, we might then go to, as you can see in my memo, discussion about bonding. That seems to be a historically an important issue, and one that's kind of been that's moved around somewhat over the course of the last 20 years. We can talk about easements some. It's a related issue. It also has to do with kind of distribution of risk between water and light and property owners and developers. Touch upon reimbursements, and then maybe talk a little bit about water and light fees and how we might approach that in the future. So first, just in talking about history, as you can see in the packet materials, what we included with the drafts, we included some documents, one document from 1994. And I'm scanning down through the packet right now. I don't know if at some point it would be more helpful for me to have this screen or share my screen. We may want to do that, but I'm scrolling down to the first minutes document from 94. It's entitled Summary of Proposed Changes for Water and Electrical Extension Agreement. That document, I believe, sort of roughly gives you a sense of where, what the discussion was back in that time period. I can't say that that's where we are now, but I think it gives you a sense of what the issues were at the time. Then if you move forward to the 1999 agreement, that's actually just a email interaction between Steve, who's on the call here today, and some other staff members. And that, again, it just gives you an idea of what was going on with developers at the time. And then moving forward from that, there's a 2004 document, just a one-page document. And just a discussion about signing on plats and subdivisions. I did a little bit of a discussion about bonding near the end of the document. Discussion about the long and the short form extension agreement there at the end of that page. And then finally in 2007, that's where everything sort of came to, I don't say came to a head, but as I think at least 3 of the commission members were present then. I think Commissioner Gormley and Commissioner Tankersley and Commissioner Fuchs were all in the commission at that time. But in 2007, there was quite a gathering of contractors, developers, I think some 25 developers, contractors gathered with the commission. I believe the meeting may have taken place in the warehouse. And there was a discussion about sort of the issues around the then existing extension agreement and problems developers were experiencing, at least perceived problems they were experiencing. And that led to this memo that Paul Elias, who was the general manager at the time, wrote to the commission in dated August 17, 2007. I can tell you that on August 21st, 2007, the commission met in their regular meeting, and they discussed these issues. And what I believe, this is a document, or the draft document that has areas of concerns, issues, and proposed resolution. I believe this was a document that was developed by Paul. I'm not entirely positive of that, but I believe that's who developed it. And it goes through various identified issues and proposed resolutions. And it doesn't always bring an answer or describe an answer, but it at least identifies a problem. I think many of these issues that are addressed in this draft document, these issues are sort of process issues that have probably over the years kind of resolved themselves. But the one kind of issue that has sort of never really been resolved has been the issue surrounding bonds. And that is addressed in this document. I think down on page 4 of the draft materials, you can see an issue identified as utility extension process. And there's in the middle square talks about sort of just the elimination of extension agreements entirely. And in the third box, it talks about whether the short form would replace the long form extension agreement. And then there's another second question about the necessity of bonds. There's a reference to warranty bonds, payment bonds, and performance bonds. But these are the historic documents, and really where we've landed is, this is in a lot of ways, this meeting we're having today is a continuation of that 2007 process. And I think we've included in this Zoom meeting a lot of our staff. Scott Wendell, Ryan Tim, Scott Rosenbaum were all working for the utility back at that time. I think John, I'm not sure if John was here then or not, if that was before John was here, but he came shortly thereafter. And so we have staff that have been kind of involved in the processes as they've kind of mutated over time. And so I think, we've had a lot of questions, or I've had questions, I know, from Commissioner Tankersley and Commissioner Gormley about sort of how things operate and kind of in the real world. And we wanted to have staff available to answer questions as things came up, as we talked about these, the issues both historically and sort of in the here and now. But in the here and now, really what we're operating under on a day-to-day basis is the short form extension agreement. After those 2007 meetings, while we still had the long form, which is a much more involved document, the resolution seemed to be to transition extension agreements to use of the short form. And that transition maybe took a year or two. I'm not really, I can't tell you for sure, but sometime after 2007, most extension agreements for development were proceeding under the relatively short form. It's about a 3-page document. And sometime in that time period, there really stopped being a requirement for bonds. And there again, that's sort of a historic transition. But prior to that time, apparently there was a requirement for at least a warranty bond and performance bonds pursuant to the long form agreement. But that process, or whatever process that process you saw in 2007, kind of transformed the extension process to a shorter form without those same formal assurances through a bonding process. There was still warranty provided, but simply not the formal assurance through the bonding. And that's really where we've been for the last 10 years. And I think, we could start. I don't know if there's more that you want to add. I know Tom and Ed were around back at that time and were involved in those discussions. I don't know if you want to give any more perspective on where the utility was even back in the early 90s when the original forms were first produced. And maybe I'll just throw it open at this point for more open discussion. If anybody has anything to add about where we were back in the early 90s.
So the late 80s, early 90s was a transition time where we got out of construction. Lots of reasons to get out. One was we weren't making any money. It was costing us more. We weren't pricing our stuff right. So I guess today continues to be that kind of that gentle, slow moving process of fine tuning the action of allowing other people to do our work that we historically, for a century had done. And I think the part that Tom and I have certain concerns about, especially going back to the meeting that Paul Elias had, is that we need to make this be user-friendly, and we need to make it be McMinnville rather than like other utilities and that. So I'm going to be anxious to hear what James tells us about his experience around bonding and that. And one of the things that we discussed with the bonding was we're not aware. I was only aware of one situation where we had to call on a bond, not Water and Light, but the city had, and then Tom's aware of some other things like that. But this will come out in the discussion. So a little bit of the history.
And a little more history. Ed's right. We were real concerned that we were not coming anywhere near to recovering our costs. And so the other ratepayers were subsidizing the developers. The second problem was we just didn't have the people to do all the work. Development had really picked up when this sort of came to a head, and there was no way Water and Light could do the work within any kind of reasonable time. So it was there was really no choice in our minds. The second thing is that I think I would like to see a document, and it's probably going to be in our policy document, that gives staff kind of guidelines as to what we expect, because we used to see all these extension agreements and the commission would approve all of them, and we've stopped doing that, which I think is probably appropriate. But I think there ought to be, we ought to think as a body as to what should be done here, and then give staff some guidance, and maybe even, and I'm sure Sam will get to it later, a couple of kind of points that very rarely could come up, but that there be something in the policy to kind of remind staff that, if this comes up, they have the authority to take some extra precautions. So
one of the things that we talked about was not reinventing the wheel. And so we had Sam reach out to eWeb and to Springfield, and I think the results were kind of disappointing. They didn't have any euphoria moment for us and that. So
well, I can tell you, we have looked at other, specifically Springfield and eWeb. We've looked at their extension documents. I've shared those with Scott, kind of on the electric side, James and Steve on the water side. And it's the one thing we don't have that they have is we don't have a formalized policy. We've operated under agreements, but we really haven't had kind of a formal rule document. which the other of those, at least those other two utilities do have. Whether, we're all different. And so, we initially sort of modeled, I think the initial draft document, although it's mutated a lot, it's changed a lot. We initially started with the EWEB document and sort of started working off of it. But I think we changed it to I think if you looked at the two documents, you might not even recognize them, recognize that it's changed enough in the editing. But it's specifically to bonding, we've looked at the examples from other utilities and from other cities. And I think depending on where, it seems to me, just my observation, it seems to me that the further you get away from the metro area, probably the looser the requirements become. And that's probably a function of just the local culture and who's available to do construction work. I did have the opportunity to talk to a bond broker that Commissioner Gormley referenced me to, I think he's Mr. Olson, I believe.
Yeah, Brent Olson, my bonding guy. Yeah.
And kind of got a perspective from him on bonding, which was probably a perspective that bonding is normal performance, and warranty bonding is pretty common, very common for cities. And then I also talked to Gary Eastland, kind of our local insurance guy, and got a perspective from him. And the perspective was quite a bit different. His perspective generally was that bonds are something that oftentimes is difficult for local owners and contractors to get qualified, that it ties up their capital resources when they have to do that. And it's much more of a challenging thing for them. Not so much of a challenge for the big developer, but a much more of a challenging thing for a smaller contractor or a smaller property owner who's trying to develop property. So I don't know if that was part of the discussion back in 2007, but I suspect it might have been. So there's that perspective also. Really, as I see it, there's really two questions. Well, there's probably more than two questions, but certainly in terms of bonds, there's a question of performance bonds. Those are the bonds that a performance bond assures that the project is completed. So a project that is started gets finished. And that's what a performance bond is. So the project gets done. A warranty bond is when the project is done, and they're sometimes called maintenance bonds. But after a project is done, a warranty bond ensures that it was done properly for a period of time, usually at least a year. And it is kind of what it sounds like. If something goes wrong, the warranty bond assures that the developer or the property owner will come back and fix it. And this is after we've accepted it into our system. So in the sort of cleanest sense, you've got a contractor or a developer who enters into a what we call extension agreement. They're also called, in other cities, we'll call them the development agreements. Then an extension agreement where they agree with us that they will build infrastructure in, let's say, a new subdivision. For our purposes, it's water and electricity. For the city, it would be street, sewer, storm, everything else. And then and we inspect it as it's being constructed, because eventually we'll own it. We don't own it yet. And during this period of time where the extension agreement's operating, we don't own the property. We don't own the stuff that's going in the ground. It's still owned by the owner or the developer. So, but the extension agreement says, if you do these things and build it out to these design specifications and we inspect it, at a given point, we come in for a final inspection, we inspect it, and then we accept it. And once we accept it, we take it. And at that point, the performance is done, it's built. At that point, we accept it, it becomes part of our system. We're willing to energize it. In other words, we're willing to put electricity through the lines. We're willing to put water through the pipe. And at that point, it enters what's called the warranty period. that's where a warranty bond would come into place. And at that point, you would have a warranty bond that would travel forward in time. In talking to Mr. Olson, the broker, what he indicated to me was it was pretty common for warranty bonds to be roughly 10% of the project costs. Performance bonds typically are for the entire cost. So if you have, because performance, you want the whole thing done. So a performance bond is typically for at least 100% of the project. In some cities, in fact, I spoke with Newberg. Newberg said they typically will take performance bonds for 150% of the project cost. And so, but typically they're going to be at least for 100% of the project cost. And that's to ensure that the project is finished. So the question really becomes, and I think a fundamental question here with bonds and with agreements is, bonds, I think, are there to reduce or eliminate our risk. And so a question becomes, what is the risk? Is there a reason to have the bond? I can tell you it is very common for performance bonds to be required by cities for these type of development agreements. It's not that it's uncommon. And there may be reasons. I think Commissioner Tankersley, he spoke to, there may be reasons, there actually have been reasons why we have required performance bonds from developers and fundamentally when our system was at risk for some reason. And where we recognized that and said to the developer, look, we normally wouldn't require a performance bond, but in this case, we are going to require one because you're putting our system at risk. And if you break something and don't complete, then we're going to be high and dry to a certain amount of money. So there are, so I guess it's I think what Commissioner Tankersley was pointing out, there's certainly probably good reasons to provide guidance to staff through the extension of policy as to when we might recognize risk and when we might want to require a bond. But then the fundamental question is, do we just always require bonds and just forgo that analysis? Or do we try to take them on sort of a case-by-case basis and say, here's a risk, we need to bond it? Some cities, I'll just tell you, some cities would probably just say, bond everything.
So,
Sam, can I interrupt you for a minute? Just so the board understands, let's take a $500,000 bond. Someone that's got average credit worthiness might be paying 2 to 2.5%. So we're talking about 10,000 to 12, say 500 for a bond. The specialty markets where people have credit issues and trying to secure a bond could be upwards of 4 or 5%. So if you think about a maintenance bond at 10% of the value, which would be 50,000 times 2%, a maintenance bond's $1,000. So the cost, it is not an extremely high cost. And I guess from a fiduciary standpoint, it's cheap insurance we're buying and requiring to protect our system and our customers. So,
and another, especially since the cost isn't so high, and I think I learned from you and other people in my practice that one of the other functions of requiring a bond, like a performance bond, like a maintenance bond or a warranty bond, is the bonding company does their screening of the contractor.
Oh, absolutely, yeah.
So if you get if the owner wants to use a contractor that that has this horrible record of not performing well, the bonding company has screened them. Now, the owner can just post cash, which normally we do too. People can avoid that and post a cash bond, but that additional benefit.
That is high risk because the cash may not be enough to cover the problem.
Yeah.
And the problem you have when you foreclose on a bond, we, the customer, we're going to get made whole, even if that costs 3 or 4 times what the value of the work was, just because of, say, potential problems.
Is this the warranty bond or the performance bond, Ed?
The performance bond.
Yeah,
Even a warranty bond, I would think that, if there's problems, they won't take care of it. We foreclose on the bond and it costs a bunch more money. Bonding company's stuck for it.
Right.
I will tell you, in my business, we will have contractors require a letter. We call it the good guy letter from our bonding company. And that's how they do credit checking on on people in my industry submitting bids to stuff, that our worthiness of bonding is the term we use.
But to get back a little bit, I think the warranty bond, that there's only 10% of the cost of the project and it only goes on for a year. I think that's a reasonable requirement. As Ed points out, it doesn't cost very much. And I think Sam, correct me if I'm wrong, but I think virtually everyone who's operating at our level would require that.
I think that's a fair statement. I think when, I can tell you in looking at Springfield and eWeb, it appears to me, although I can tell you their extension policies are not the clearest in the world, it looks like eWeb requires warranty bonds. And it's not clear. Springfield has a very sort of open-ended, we require appropriate bonds kind of thing. So it's not particularly clear exactly what they require.
Okay, and then on the other issue, Ed, sorry.
So Tom, this will be to Tom and to Sam to share with the board. I think if we're going to require bonds, we require bonds, and that's it. We don't do hit and miss. So we have to be consistent.
I would agree on warranty bonds. I think every job.
Yeah. So Tom, I think though, in retrospect, whatever the board decides to do as a final document, before we ever vote on it, I think we need to hold a Paul Elias type meeting with the people that in our community this affects, just to feather it out and respect for the people that are going to be involved in this.
I think that's a good idea.
And then the other question I would have is, where are we currently with the contractors? Have they said anything to us on the bonding issue? I'm guessing it's not as critical, or the communication isn't as critical as it was in 2007 with our focus on customer service. But where do we sit right now with with those out in the field?
Well, I've not heard anything, and I don't think Tom has either. And and Pat would be another. I mean, that's kind of our sounding board. This is McMinnville. People are upset. They're going to come hit one of us about something.
How about staff? Is staff hearing anything about this? No?
Not hearing much, no.
Sam, I think we are not requiring performance bonds at this point, right?
We aren't.
Well, we're not requiring performance. I don't think we're requiring warranty bonds either.
No.
Right. And I guess maybe I know James unmuted himself, but he might offer some perspective on bonding, even on bonding of very small projects, which is another thing. Our extension agreements apply to large projects, but they also apply to potentially to small projects where a developer or a property owner touches our system. So I might defer to James on that.
In regards to bonding, I don't think there's much of a debate in regards to the warranty bond, but in regards to performance bond, where I've seen it typically used is when they're touching our infrastructure. When I say our infrastructure, I mean that we've accepted it, it's in our system. If they want to go out, Chipotle is a great example out there on Highway 99 right now. They go out there, they tap our main. That's a situation where it would be an extension agreement if they tapped it with a bond, because they're touching our infrastructure. In regards to a new development, like they're putting in a housing complex like the Baker Creek or something like that, that's something where we go through a process. I mean, they design it, we review it. We don't require a bond on it at this point. We probably should on the warranty bond, but not on the performance bond, because it's not our infrastructure at that point. We haven't even accepted it.
Big difference.
And that's the difference. I think that the contractors would say the same thing. Is like the property owner should probably bond it. They're doing the work, but we may not accept it at the very end. They have to go through a permit process with the city for land application. They have to go through, or for water at least, Oregon Health Authority for review, plan review. We do a little bit different in McMinnville in regards to plan review that we just started over this last summer, where all the plans for water do go through Oregon Health Authority for a plan review process. So they're tied into that. So the engineer designs it, they send it over there. They communicate with the city back and forth and us, and then they issue a permit to the actual design engineer. What makes it happen on that side is the design engineer has to be on site throughout the project to make sure it's built per plan. And then he signs an affidavit at the end of the project saying it was built per plan. We've inspected it also, and then that's when we take it over. And that's where the warranty bond would come into play.
So real quickly, it seems to me there are only three times when we would need a performance bond. One is, like James mentioned, where somebody taps into our main and we want to make sure they don't damage it. Or I think Sam or John mentioned to me that there was one where the subdivision, the way it was laid out, they wanted to lay it out to maximize the number of lots. They had to move a main that already went across it. And in that case, since they're touching our system as it operates now, they need a performance bond on that in my mind. So like James said, there's that. The second one is when, if you're, as I understand it, if you're a developer and you want to file a subdivision plat, for instance, before the plat is final, the city requires, we have to sign off that we're satisfied, but the city requires that all the improvements be in and inspected and accepted. But if the developer needs to plat it for some reason beforehand, they can bond these improvements. And so in other words, the plat gets signed by us and the city and everybody else, and the lots are legal and everything's developed, but the infrastructure isn't done yet. In that case, I think we need a performance bond. I don't think many people do that here, but I think we need that one. And then finally, and this doesn't happen very often, but if we're in a situation where, imagine that our infrastructure ends on this side of, where's my camera? On this side of the street, there's a lot here in the middle where I am. Then there's not a lot, but a subdivision in the middle here. Then there's another subdivision on the other side over here. So you have to cross, I'll call it subdivision 1 over here to get to subdivision 2. If we're entering into development agreements for both of those subdivisions at the same time, I think we need either the easements, we either have to wait on the second one until the infrastructure is in and the plat is approved so that the easements are final, or we have to require a performance bond. And the question is whether subdivision 1 or 2 would pay for it. But the problem being that if subdivision 1 doesn't get finished, then we can't do what we said we do under the agreement with subdivision number 2, because our infrastructure won't be all the way out there. And if the plat's not approved because they didn't finish it, we won't have an easement. So that would be the third time in my mind that we would need a performance bond. But other than that, I'd like to also have something where the general manager deems it appropriate that we allow it, and something we can't think of right now. But basically, I don't think we should just automatically require the developer to pay for a performance bond if one of those circumstances or something else we've thought about doesn't come up, because that's real money, because it's on 100 or 150%, and that's going to increase the cost of housing in McMinnville. I think without enough risk that we're foregoing, the risk that we're trying to avoid isn't high enough. So that's where I come down on that. But I think we do need to have in our policy the things James talked about, plus the situation where, the city does require the same kind of, if the city would require them to bond the streets, the performance bond the streets and the sewers and all that, if they wanted the plat recorded. I don't think that's happening much anymore, but it used to happen. I know.
I can tell you on your second scenario regarding the plat, when we sign plats, or when John signs plats, the reason we do that under the statute is what we're saying is the water provider. We're saying water is available to this property. That's really the fundamental reason we're signing plats. We do review them, and we check them. We sort of do the because the surveyor is supposed to put all the easements. They're all supposed to be listed in the plats, and we do look at it, and we see an error, we call it out. But the fundamental reason why we're signing off is to sign off to say water is available. Now, there's under statute, there's 3 options. We can sign and say water's available, meaning we're satisfied, everything's done, we can provide water to that subdivision. Our second option is if we can sign off the plat and say no water, where there's no water available, and that goes on the plat. And we've actually done that at times when people want to plat property and we have not provided water. It goes on the plat that there is no water available. The third thing we can do, and we've done it seldom, is it also provides in the statute, we can bond it. We can essentially take bond or cash deposits. And we have done that. There have been some times, I know I've, within the last 5 to 10 years, at least was done once. So actually in the statutory process for signing on plats, those issues are addressed. It's not that we shouldn't address them. We can call them out in an extension agreement document, but that is an issue that we sort of deal with. I know I've had these discussions with Steve on numerous occasions about why are we signing a plat, what that means, and when we can and can't sign a plat.
Sam, let me just make a comment about cash. Everybody thinks, well, that sounds great, but if we're talking about construction related activities, when the cash is gone, that's the end of it. And if there are problems and it takes 2 times the amount of cash to get the job completed, that's where the bond has standing. So I think we need to be real careful about taking cash. Cash is not necessarily a good thing to do because the liability for that guy ends at that point, so to speak, short of us suing him and that. So the bond just makes life much easier.
I was always under the impression that the bonding company's liability was limited to the face amount of the bond. But no?
Not on a performance bond. And I don't know sure about a warranty bond.
So why would you ask for 150% versus 100%?
Because potentially it's a punitive thing, as how I've seen it before. It's more punitive than anything.
Oh, okay.
It's a build a fire under somebody, get their work done.
Yeah. We could look into that, but I think I think cash has an advantage in the sense that bonding companies don't just write you a check.
No, you got to fight. You got to fight with them. That's the problem.
So sometimes having the cash there is a better incentive to get the thing done. And some small contractors and small developers couldn't bond it.
And I can tell you that even the 1994 long form did provide for a cash alternative to bonds. So it's not that that's different than what we had in place 25 years ago, 26 years ago.
Sam, can you talk to the bonding people, please, either Gary or Mr. Olson, and find out exactly what that is? Normally I would just take what Ed says, but when some jurisdictions require 150%, that implies to me that they want a cushion over the cost of the project to fix it, because I understand that fixing a project can often cost more than doing it right the first time.
So you're asking whether or not the bonding, the surety's liabilities is limited by the bond amount.
Right.
Right.
That's the question, right, Ed?
Yeah.
I'd like to make a clarification comment too on the bonding. In the old long form, we never did take a cash deposit for the performance, only for the warranty bond.
Okay.
Thank you, Steve. So I don't know if anybody else wants to chime in. I know we've heard from kind of the water side of it. Really, I haven't heard from the electric side. I don't know, John, if you want to address that in terms of bonds and how that might apply to infrastructure on the electric side.
Well, the infrastructure on the electric side is, so much different because it's pretty much vaults and conduit, and our crews do the rest of the work. Where water, their contractors putting everything in essentially. So once that conduit's proofed, it should be in good shape. And you agree with that, Scott?
Yeah, and one other thing I was going to add is they don't really touch any of our infrastructure. So where they have to make connections, even as John said, they're just putting in conduit and vaults. But if they're extending conduits out of an existing vault, it's usually our crews they're assisting with that. So they're not really ever working on our infrastructure.
So the only problem would be if they got a bad batch of conduit, right?
Essentially, yeah. And typically what I've seen, the one instance I saw was where the contractor actually put a schedule 20 conduit in instead of a schedule 40.
And we missed it?
That wasn't here, but yes, the inspector, our inspector missed it. Typically the conduit is, if we're inspecting that conduit, we should be looking for those things. Schedule 40, PVC, electrical PVC, the joints are done properly, entrances into the vaults are correct, vault elevation is correct. And I think the only issue we've had that I know of since I've been here is the vault over time actually became not level. It settled. I think any
What's
other
the cost to fix that?
basically, well, Scott, you may be able to answer that better than me because our crew usually goes and does that, correct? Because it's energized at that point.
Right. That's, I'm trying to recall that one, but that's something that's very rare. But if that was to occur, then we have to probably pull the wire out and lift the vault up and recompact, add some rock and recompact rock underneath the vault and set it back in there. So that's a pretty major undertaking.
Okay.
So you may be looking at what, a day of crew labor to do that, depending on the vault.
Yeah, depends on the vault. So something that's probably a little more typical and again has been pretty rare in the last 10 years or so, but inspections are done, contractors proof the conduit, so everything looks good. But over time, if the installation wasn't real good, conduits can separate, whether find a joint that wasn't glued or something. That can cause us trouble if we don't get in there to pull the conductor fairly soon after the installation. But again, those types of things are pretty rare.
And that typically would be outside the warranty period if we were in that situation.
Right. But the typical situation when the installation happens, we're out there fairly soon after that, pulling in the conductor and set the transformers.
And what is the cost? I'm trying to evaluate the cost of the developer. What's the cost per lot of doing the electrical extension work, roughly?
Ryan, you have a good idea on that? It varies depending on what,
Sure.
if we have to have 600 amp versus 200 amp in there as well, and the size of the vaults. But just a typical subdivision, Ryan, you have an idea off the top of your head?
For the contractor's piece of it,
Yeah,
I'd have to go back and look through engineers' estimates. Because they typically don't break it down, as a per lot. It's a lump sum amount of conduit and vaults and trenching. So we could get an approximate figure.
Yeah, I'm just trying to see if it turns out it's, the bond cost, with the bond being 10% of this cost, it turns out to be a few dollars a lot, then we probably ought to require it. But if it's a lot of money per lot, we probably shouldn't, given the risk that staff is talking about here. This is the warranty bond.
so maybe Ryan, you could do a couple of typical subdivisions and see what those typical per lot cost would be.
Yes.
Thank you.
Well, and Ed suggested to us that maybe we have the contractors come in, we have not public meeting, but have an open meeting of contractors and just get a sense of where they're at, whether it be on water or electric. We could probably get a cost estimate on some of the electrical costs per lot and get a sense of that too.
We typically get that information because that's part of our cost of, our construction and aid.
Uh-huh.
We just have to break it apart.
Okay.
Great, thank you.
Just to note that one of the issues, I think it was raised back in the 1990s and has changed over time, is we do separate, maybe obvious now, but we do separate agreements for water and for electricity. And I think originally, I think it was one agreement originally, and that was part of what slowed things down. And that was a correction that was made, or a change that was made to kind of to improve the process. So I guess I have a sense that we've probably concluded that kind of got us to a situation, or we've kind of concluded consensus that at least on the water side, warranty bonds are appropriate. And there's a sort of a series of things that we may be looking at in terms of performance bonds to sort of condition whether performance bond is appropriate on the water side. And on the electric side, okay, Ed or Tom.
Sam, I haven't heard from Jody or Patrick yet, so I don't think they had any input before we had a consensus.
Sure.
So, this is new for me, so I'm following what you're talking about. It seems reasonable about the warranty bond versus the performance bond. My concern is the cost to the project, and sort of where I was originally thinking about the affordability piece. I hear that a lot from contractors. I do think having meeting, I noted that it was in the 2007 document. I think having a meeting with the users is important, not only for the bonding question, but just making sure that you're understanding the current conditions in which they're working, and also where there might be improvements in simplifying and streamlining the process. So that's what I have to add. Thank you.
Patrick, you want to weigh in?
I guess for me, I understand the need to mitigate our risk, but I tend to be on the light touch side of the fence and not having onerous requirements for the folks out there actually building and producing. And so it was the interesting part of the conversation this morning was that there's less risk, it seems, on the electric side, which I thought was interesting. And so, it's that like anything else, the devil's in the details, and it's that balance of making sure that we have, non-performers make it right, but not add to an already incredibly high cost for housing that we have here today. And I agree with Ed on, it's this, one of our main problems is this whole issue of the urban growth boundary and inventory of land to be able to build. But I want to make sure we're not, further exacerbating that.
So Patrick, going to your question about the risk on the electric side, I think the reason why it's so much lower is the contractor is just providing a pathway, and we actually do all the electrical work.
Yeah, I get that. That was just more of a,
Yeah.
Didn't really know that in the past, and that was kind of cool to learn today. And I appreciate the amount of granularity you guys have in describing how things work, because it makes it easier for me to figure out, okay, what's the best combo here to make sure that, we get the costs of providing housing for folks down as reasonably as possible, but don't have a significant exposure to the organization and to our ratepayers.
But I will also tell you, there is a utility to the north of us that requires the developer or the contractor to put all the electrical infrastructure in, including the transformers and the primary wire. So that is not, it's unusual that electric utilities do that, but there is one here locally that does that.
Is it a muni of sorts, or is it a public?
It's a PUD.
And that's in Washington, right, John?
Yeah, it's Clark PUD.
Okay, well,
That's common in Washington, or fairly common.
I mean, help me, Scott, and John, if I'm wrong, but my perception is that we have the ability to do that and keep up with the subdivision work, and that we're a lot more confident in our people than somebody else's people.
Agreed.
I would much rather our crews did the installation of pulling conductor and transformers. So we go through a testing process and everything.
And we charge for that, right?
Yes.
Correct. Yes.
Well, especially in that we're going to maintain it once we take ownership of it. We want to make sure that it's up to what we want and what's easy for us to work on. Correct, Scott?
Yeah.
And you have to think about it from the perspective, there's so many parts and pieces that could go wrong on the electric side with both overhead, underground, secondary, primary connectors, that we want to make sure that our crews are doing those things so that we know each one of those things are done properly.
Yeah, there's a lot of installation practices with underground systems. You know, there's pulling tensions you don't want to exceed when you're pulling in conductor, and you don't want to, well, you want to do a neat, accurate job of making the terminations on the high voltage installations. You don't want to nick insulation or the conductor, and there's just certain tools and practices that we take extra steps to make sure that we have a long-term product.
Well, let me share just an observation from my perspective. You know, I really do think that we ought to have that meeting with the contractors and the developers out there. But I can tell you that I, on a monthly basis, go to the Affordable Housing Committee, where we have 3 contractors and a developer on, and I don't hear any comments about working with Mac Water and Light. You know, we've been working very hand in hand with Stafford out in Baker Creek area, and things are moving along in Baker Creek. The first phase, the apartments are going in and they're starting to move into some of those. They're already scraping the dirt for the phases across the street right now, and I've not heard any complaints. Matter of fact, I've heard from the developer how easy the city and Water and Light is to work with. So just to give you an idea, but they're focused more in the Portland metropolitan, where there may be more regulation than what we have here. But that's my sense, just from the meetings I've been involved in the last 2 years.
A question for you guys, though. I kind of got the impression that over the last number of years, we've had not as much in terms of performance or maintenance bonds as a requirement, and we're kind of going back to maybe a little bit less onerous, but still now starting to require that. Is that accurate? Is that what I got from this conversation?
Well, I think if you look historically where we were in the early 90s, we had we never really had an extension policy, but we had a roughly 15-page long form extension agreement that had requirements for kind of a full requirements for bonding and a host of other things. And I think that was, which a person might describe that as more onerous. And that led to this sort of historical process where we ended up in 2007 with this meeting of contractors, developers coming to the commission and saying, we think there's, I mean, you can see the document where there was some complaining about the process, about the need for extension agreements. Actually, I mean, I think the contractors, developers were questioning the need for the agreements at all. That's not an answer, but that was the feedback, and questioning the need for bonds. And so that feedback led to a sort of reduction. And really what it led to was, because we had 2 documents. We had the long form document and we had a short form document that really was intended for very specific, small projects. Well, that became the default agreement has become the default agreement for everything. And so, and that document did not have a bonding requirement. And so the process sort of mutated to that over time. And that was sort of, I guess, a decision made kind of in response to that 2007 meeting, and also sort of a decision, frankly, by management, just sort of how to adapt to the changing world.
So I guess my point is, oh, go ahead, John.
Well, what I was going to add to Sam's is also, doesn't our agreement have a warranty provision in it as well? It just doesn't have a bond.
That's correct. There is a warranty in the document that we have now. Yes. It's like
Okay,
so we have a
so-
contractual warranty.
So my point is that the reason you guys haven't been having complaints from contractors is because you've had more of a light touch and not requiring all these bonds. And I'm wondering, if we're going to start requiring bonds, is there going to be another insurrection? And then we have to deal with that.
I don't see a pushback on the warranty bond. In regards to the performance bond, where if the contractor sees that we have risk there, they'll probably disagree with it, but it's still, that's our duty in regards to making sure that it's bonded. If we have risk to protect our system, it needs to be bonded through a performance bond.
James, given our earlier discussion about when we might require a performance bond, that would, if those were the rules, it'd be very, very rare situation where we require it, right? Most subdivisions don't require it under those rules.
Most subdivisions wouldn't require it, but we would require it with the smaller projects where you might hear from the smaller contractors that are performing the hot taps, for example. We would tell them they need a performance bond.
Mhm.
They might hear from a developer in regards to permitting, like why do you make us go through Oregon Health Authority? Springfield doesn't make us do that. Why are you making us do that? Those kind of questions.
So James,
Yeah.
the example we had, the Chipotle, what size tap was that?
What was that?
2 1-inch and 1 2-inch.
2 1-inch and
And 1 2-inch.
1 2-inch.
So why did they do that instead of us doing it?
That was in an ODOT right away, and it was night work. So it was through the engineering process, Steve and I made that decision that we didn't want our crew to go out there and perform that tap in the ODOT right away. So, and then they were fine with that. We did have an inspector go out in the evening and witness it though. And they paid for those they paid for all those costs.
So in that instance, do we have a rough idea what the costs were for that
Steve, do you
portion of the
want
project?
Which portion of
The
the
taps.
The overtime or just the hot taps?
The whole portion of the project to tap that.
I do not have that number. Yeah, because they're going to pay for those hot taps. We're not going to have any record of that. So
it's under 10 grand.
it should be under 10.
Yeah, it's under $10,000. Enough where they didn't push back at all on it.
And so their bond is $10,000.
The bond,
There is
10,000,
no
if we're
bond on
talking
that one.
2%, we're talking $1,000 for the bond for that project.
No, the amount, what's the face amount of the bond? Do you remember, James?
There's no bond on that.
Oh, there isn't.
No.
No, that's what I'm getting at, is if there was a bond, if it's $10,000 and it's 2%, it would be $1,000.
So we want to make sure they're a licensed contractor, but at this point, we aren't requiring a bond for the tapping.
So
I understand, but what I'm getting at is if we had a bond requirement, that's the cost of the bond.
Right.
So to clarify, the hot taps are only done by an approved tapping company, and at this point, it's only A&A and Ferguson. So we do have records, insurance, and stuff on file for those companies. So they have to hire A&A or Ferguson to actually hot tap our water main. Then the contractor, and in this case for Chipotle, would then continue that service run out of that tap. We don't actually allow just any contractor to tap our hot water.
Now, with this new performance, with this new extension agreement, we would actually be requiring them to have a performance bond with that.
But the point would be that if they just tapped it and stopped right there, left a hole in the road and walked off, who's responsible for that? To finish that project?
Well, ODOT would probably come to us and tell us to get it out of the right of way. So we go out there and run a 2-inch service, bring it out and leave it there.
So that's why you would want a performance bond then.
Right.
So
But
those costs-
that amount of work is so small, like dollar wise to us, the risk to us to do that is pretty minimal on something like that. That's why I question a performance bond in there, but they're touching our system. But yeah, that would be the case, John, where we'd have to recoup that money.
So maybe our policy should also allow staff, unless it's going to cause you too much trouble with, fighting with the contractor every one, allow staff to waive the performance bond when it might otherwise be required if there's minimal risk to water and light. Is that unwieldy? Does that cause too much friction with the contractors, everybody wanting that waiver?
I think that's a good common sense, honestly, in regards to that, depending on what it is. Tapping our main is fairly high risk if you're depending on who's doing it. But in that case with Chipotle, we're out there witnessing it. But yeah, I think that's a fair statement there.
So James, how big a main were they tapping?
The 12-inch.
That's a 10-inch.
It's a 10-inch main out there.
So what if 10 months from now, we have water showing up, we have to dig down, see what it is. We find that they cinched the saddle too tight, happened to be a piece of pipe that was fragile and cracked the main, we got a leak.
There's a
What-
warranty.
what-
there's a
What do we
warranty
do?
on
What's that?
it. We go back to them on the warranty piece and talk to them.
Do you have a document that they've signed that said they're gonna,
That's in their extension
Yes,
agreement. That's
it's
in their
a-
extension agreement.
okay. So you do have a tool that could go back and get them to rectify the problem then, okay? Okay,
And assuming the contractor hasn't already used up their bond on their contractor's bond on other claims, then there's that bond with the CCB that's there, right? You mentioned these were bonded contractors to tap mains, special bond, or
It's not a special bond. They're just licensed. So when they're licensed, they're going to have bonded.
that's probably not.
this, the company Double A Drilling, this is their specialty, is tapping piping
That's all they
system.
do.
I've worked with them before. We've had them do big pipe inside of buildings to tap mains and that, so.
And we witnessed all the taps. On a typical, normally we would tap something that small. Our crews would. But given the circumstances on Chipotle, it was a little bit different.
Yeah.
Any other
Sorry.
discussion?
Sorry, to answer your question real quick, I do think there'll be a little bit of pushback in regards to performance bonds, but I don't think it would be, as long as it makes sense, I think it's fair. If they come back and the contractor's having a misunderstanding saying, hey, this, why would you require this on there? That's a point of conversation we need to sit down and talk to them about.
You want to talk about your next topic, Sam?
Sure. So I guess just to wrap up the bonding, it just sounds like we still need to do, I think what the commission is telling us is we need to do some type of meeting with contractors to get additional feedback based on what we've heard today. And it's probably bring that back to the commission again after we have that feedback.
Or would they rather prefer that we have, once we have a draft document, that we bring it to the contractors?
I think that's better for the meeting so they know what we're talking about and they can focus on it. Staff might informally talk to some contractors in the meantime, and tell them there's going to be a meeting. But I would think that it's going to be more productive to say, here's what we're talking about. What are your comments? Patrick, does that make sense to you? Or Jody? You're
Yeah,
muted.
so I just want to make sure I'm tracking. So we're looking at performance bonds only under certain circumstances, not a blanket.
Yes, that's
Okay.
what I understand.
All right. Yeah, and I do agree. I think having something for the contractors and developers to react to would be more helpful than sort of just an all call for concerns or comments. I think having something to look at would be good.
Patrick?
Yep, I'm fine with that.
And I feel good with that too. I think if you get them involved too early in the process, they may want to put more of their language in. And I think it's better for them to react to what we feel is appropriate.
Okay, the next item we might touch on briefly are easements. That is, that's covered in section 9 of the policy document. And then there's also an easement document that's attached as part of the packet. But the question here is a similar question, and I guess it's for discussion or information, is about when we take easements. Really, the question is, when should we be taking a hard look at title? When should we be requiring title insurance or title reports? I know I've had a discussion with Commissioner Tankersley about this in some detail, and that's, I think what you're seeing there in section 9.2.3 is an attempt to sort of flesh out when we may need to report and when we don't need to report. And then allowing some discretion to the general manager on that issue. And then also in 9.2.3.1 that even where we have superior liens, the commission may choose to accept the superior lien, just recognizing that the easement may be at risk down the road if there's a foreclosure.
Sam, could you explain what a superior lien is?
Sure. Well, sorry about getting ahead of that. If a superior lien, so if we have, if there's a piece of property and we need an easement on it to place some infrastructure, either a part of our water system or part of our electric system, we will ask that the property owner to convey to us an easement in the form of the document that you see attached in the packet. Now, when we take that easement or that grant of that easement right from the property owner, we take it subject to any liens that already exist and are recorded on the title of the underlying property. And so if there's all the property rights tend to have, they have a priority based on time of recording. So if I record my mortgage before you record your mortgage, my mortgage has superiority to your mortgage, and I can basically get my money before you get your money. And so in terms of financial liens, what happens, and we saw this more during the financial crisis when there were a lot of foreclosures going on. But if a bank has a mortgage on a piece of property and we take an easement on that property, and then later the landowner defaults on that mortgage, the bank may come in or could theoretically come in and foreclose the mortgage. They'll take the property back, but they take it back with the title as it was when they took their mortgage. And all the later lien holders or encumbrances that came onto the property after they took their interest may be foreclosed out, may be wiped out. And so if you take an easement from a property owner that has a financial lien on it, you are at risk of losing your easement or your encumbrance if that financial lien holder would come in and foreclose either judicially or non-judicially, through the courts or not through the courts, and essentially take the property in lieu of the debt, and in doing that, wiping out all the junior liens and encumbrances. Does that make? I know that's a lot, but does that make sense?
So Sam, are you saying that if you have an easement through a property and the primary lien holder, the first mortgage position bank, forecloses on that, you can lose your right to an easement? Is that what you said?
If you're junior to that financial lien, the answer is yes.
Which would mean, later on, like you got your easement a year or two after they had their primary mortgage put on the piece of property.
Right. If you came to the property after the mortgage loan was recorded, for example, when we looked at purchasing the BPA line from BPA, we did a pretty thorough title research on those easements that BPA took back in the 1960s. And back in the 1960s, when BPA went in and took all those easements for all that transmission, at the time they did that, they did title reports on those properties. And when they found those property owners had mortgages, they were going to the banks and they were asking the banks to subordinate to their easement, because EPA did not want those loans to go bad and have those easements wiped out by a foreclosure. And so that's the potential risk you take when you take an easement from somebody. If they have an underlying financial lien, usually a mortgage, a trust deed, then if that debt were to go bad, your easement is at risk. Now, as a practical matter, there's certain practical applications to that. If we're taking an easement from somebody and we're taking it because we're putting some type of infrastructure on it, and the only party that it serves is that property owner, if it just serves them, then the relative risk may be pretty low that even if the property is foreclosed, that the bank would tell the electric company or the water company, we want you out. Okay, that's probably a relatively low risk of occurrence. The bigger risk is if we have transmission through somebody's property that maybe doesn't even really benefit the burdened property. And that would be an instance where we're transmitting either electricity or water through somebody's property. We've taken an easement. That's a situation where and we have somebody down the road, somebody beyond the burdened property that is served by the electricity or the water, then we've got another portion of our system that may be at risk. And so that might be a system or a situation where we'd want to take a harder look at the title as we take the easement.
So when you think with the potential for significant amount of defaults coming in the coming years on properties, and we have an easement through one that doesn't necessarily benefit the property owner, I think of that, the easements that the water line goes through from up, the dam down to town. And, I don't imagine we've asked banks to subordinate their, primaries to our easements.
No,
I mean,
but right. But actually recently when we modified easements when we modified easements on the transmission line, if you're thinking about the 36-inch line, when we did that, we modified easements in that case. We ran title reports on all those and looked at title to make sure we didn't have prior financial easements.
Okay, so you do all that work on the front end to mitigate that risk. What happens if, we had our easement after like a mortgage was put on a piece of property? Do we ask for subordination, or how do we mitigate that risk today? Or have
if we have the easement, if we first have an easement and then later they put a mortgage on it, we're superior then. We have the first and time.
Yeah, right. I get that. I'm what the flip-floppy though. What happens, or do we just not? We do our title report and we just make sure we're not subordinate to a primary.
Right, and the question is, are we? And what the policy is saying is, if we have a concern that it could put our system at risk, essentially, again, it sort of relates to the bond question. If in taking this easement, we are putting ourselves at risk of losing it, and that we will hurt somebody beyond that property owner that's being served, then that's a situation where we would want to take a look at the title and make sure we're not taking an unreasonable risk in taking easement that's inferior to a superior lien.
And then Patrick, I assume your question is, well, if we find something on there, then do we normally, if it is an unreasonable risk, do we normally then require a subordination? Is that your question?
Yeah, that's my question. I'm trying to figure out how.
Yes, that would be right. That would be the way to address it. We would go to the bank and say, now I can't say in my experience, that's not a, I can't even say that, have we done that? If we've done it, I don't recall when we've done it.
Well, Patrick made mention of, the water lines that we were going through the farm property. Did we check to make sure that the farm was without a lien, or did we subordinate? And this would be in the last 2 years that where we were getting an easement through that farm and the vineyard and that.
Yeah, we checked the titles. We ran reports on all those properties to make sure, and we did not have any superior financial liens to subordinate in that case.
Okay.
So Sam, one question I was thinking about, what happens when we get an easement and somebody has a construction loan prior to a mortgage? Do we become superior to the mortgage? Because they have not recorded that yet.
I'm not sure. I'm not sure I'm following.
In my
Yeah, I'll-
in my experience, John, if there is a construction loan and then they finish the construction and they have a takeout loan, a final long-term mortgage, and our easement was
In between.
after the construction loan, but before it was the long-term mortgage. If it's a different lender, I think we're clearly first, okay? But some of those construction loans that I used to see, it would be they convert from the construction loan, the same lender would convert, and I think then I'd be worried about that. But you would have caught it when you found the construction loan.
Right, because that would be a scenario that would happen probably more often than the other way, where somebody's building something.
And one more thing that as I understand it, when the plat, if it's a platted subdivision, as I understand it, the lender is required to subordinate by the city before they'll allow the plat to be recorded, because they don't want the city streets, for instance, to be subject to the mortgage. So in my experience representing subdividers, we were always required to give a title report that showed a clean title to the public areas anyway. And the bank is happy with that, because when the plat's recorded, then they have, instead of a lien on this undeveloped property, they've got a lien on all these lots that are saleable. So that, I think the banks are pretty used to that, or at least they used to be when I was doing that kind of stuff.
So Sam, did we give you clarity on easements?
Yeah, I guess the question is I don't, and maybe I'm wrong, but I don't see this as we're going to take a look at those things when we run into situations where we feel again that we're at risk for transmission purposes.
Yeah.
And so when we're not at risk, we're taking easements, but they're for the service to the property owner and themselves. We're not going to be as concerned, and we may not require that same type of examination.
And sometimes you don't even take easements, right? Like if I wanted power from the street to my house, you wouldn't take, like if I had a bigger property and was building a shop and I wanted another line to go, you wouldn't necessarily want an easement there because of.
No, in fact, I don't think we do. In fact, that's not a situation where we would take an easement.
Because if something happens and the bank says we're foreclosing Water and Light out, Water and Light says, okay, you can't have any more power. So if it doesn't go somewhere else.
Yeah, Tom, that's what we do on the fiber side. If we go through someone's property and it doesn't necessarily just serve them, we get an easement. And if it's just a drop for service, we don't get easements. So it's very similar in our world.
And that saves problems. It saves time and money for everybody. And it kind of sort of a self-healing wound if there's a problem.
Okay.
Clear as mud.
Dan, there is a test afterwards, right?
Yes, there's a test.
It's open book, nobody worry.
The next thing we're going to talk about briefly we'll talk about reimbursements. This is something that occurs as in the extension process. And we currently have, our process currently is to provide for certain reimbursements to contractors for cost sharing. And this is a result of situations where we as a utility are asking a developer to essentially oversize pipe or conduit above what we might normally require under our specifications. And in that case, under our current process or policy is to provide reimbursement based on material costs. And what we would be doing in this revision or this new policy would be to continue that practice.
Okay, you want feedback on that? Or I mean,
Well, I guess if you have, I guess the limitation, and we're really, and you can see the reference in the memo is to this concept of rough proportionality. I can tell you, it seems that we do have an obligation to share that cost if we're requiring the developer to do something beyond what's reasonable to expect from them for the development. And I guess the question may just be at this point is if you're satisfied in the kind of sort of the current standard which relates to material costs.
well, I guess the issue would be how much complaining have we had, and I'm not aware of any. And I think maybe the city itself does much more of this with sewer lines than anything else. I'm trying to remember. Can you give me some incidents in the last 5 or 10 years that we've paid somebody extra money to bump up a water service, a water system?
I might defer to
Steve?
James or Steve.
There have been a few subdivisions where we've required 8 inches our minimum standard for a water main. Alan Rudin up off of McDonald. That was one I believe we did. We've done a few of those.
Have you had any pullback though when you say this is what we're going to pay, or?
Not really. It's been a pretty accepted practice. Upsizing, just paying for materials only. Trenching sometimes might be slightly wider depending on the size of pipe and whatnot, a little bit more labor, but that seems to be accepted as a pretty fair process. I couldn't speak to the power side on the conduits. Ryan could speak better to that.
But
I don't know.
I think it probably happens more with the sewer and storm drain as we're building, making sure that we have capacity for further development beyond that.
We do have similar instances on the electric side. The extension of 2nd Street further to the west is a good example where we put in facilities anticipating the need to run 600 amp primary power back there. And in current times, the extension of Colvin Court towards Riverside Drive will be another instance where we need to plan for the future and have what you could consider oversized facilities installed so that we can make a connection to Riverside Drive in the future and guarantee quality of power delivery in the industrial park.
That makes sense.
Okay, well, those are a couple examples for you. Are there any other questions relating to reimbursements?
I think it's working fine, to be honest with you.
Okay. And then generally, we might just bring up the issue of fees. The fees for sort of development fees, application fees, per lot fees, I think have been relatively static since the early 90s. I couldn't. I've not done an exhaustive legislative research on this, but it appears they've been pretty static. And so just bringing that issue up, whether or not we want to revisit fees, they're generally, they're located in the miscellaneous rate schedule, and they're also located in what's called Schedule 0, which is where the per foot sort of inspection fees are located. And so I don't know if that's if that's something you want us to look at in the future in terms of bringing those fees back for review.
Let me just share a little bit. At the city, now that we can break out our costs by department and we really can get a much better total cost, as we have been updating code, we've been going in and looking at fees just to make sure that we're getting to cover our costs. And I'm wondering, in that we've now broken our financials down to look by department, if that would give us a better look at our total cost and be able to make sure that we're recouping the total cost, because we have more focus in our accounting system.
I would agree. I think we need to make sure we look at our fees to make sure we're covering our costs.
And not as a revenue enhancer, but just to make sure we're not subsidizing one set of customers at the expense of another one.
Right.
Absolutely. It's the fair thing to do for our rate players.
Yep.
They're costing the bill. We're not putting a burden on them to take care of other things that are in a growth mode.
Yep. Okay, so we'll look at those and make sure that they're meeting our needs, our cost needs.
Okay, Sam.
Okay.
Any other things that you'd like to weigh in with the commission?
No, I think I've about reached the end of what I've got here on the agenda.
I'd like to thank Sam for not saying the end of his rope. As may be evident, I've been very interested in this process, and Sam, and then the staff people, and John, and then the staff people they contact to answer my esoteric questions have been very patient and very helpful. And I think that we're going to get a better process that's fair to everybody because of it. And I really appreciate the help.
So at this point, then, we'd get the draft together, be sent out to us to kind of give a thumbs up, thumbs down, and then hold a meeting. I'm not going to call it a public hearing. Hold a meeting with the constituents that this affects.
That would be what I would
Okay.
say would be the process.
And I think we want, at least one or two board members there, just as long as we don't have a quorum. So.
Yes.
Okay, so probably I'm just thinking of time frame. It'll probably. Do you want to see this document? Do you want to see this document again in a meeting setting before?
I don't need it in a meeting setting. I just want to look at what it looks like, in final form before you bring it to a formal meeting for adoption.
So it would be final draft, Ed, a final draft?
I would think so. And then, I really want to hear what our constituency says about this.
Okay. So we'll get the document drafted again, or redrafted with some changes, probably back to Commissioner Tankersley and Commissioner Gormley for comment, and then on to that proposed sort of meeting with constituents.
And I might comment that it may be better for somebody else other than me, because there are circumstances. I work with the department a lot in my occupation. So I have a quasi conflict. So I think it'd be best for some other board member to deal with that stuff. So.
I'd be interested.
Patrick would be perfect for that, really.
I would be interested in attending that meeting, but I defer to
you would
the others.
You really would be.
That'd be great, because I think Patrick has the same issue Ed does theoretically.
He does, yeah.
Good. That'd be great, Jody.
So Commissioner Christensen, so you may see then, maybe what I'll do is send, maybe as I redraft this, maybe send you a revision to let you look at it. Just to kind of catch you up, if that is acceptable.
Mm-hmm.
And to speak to Ed's comment, his involvement to date has not concerned me about the conflict part, because basically I think Sam and I relied on Ed's expertise as to, you know, sort of what happens in practice and how would this apply in practice, and he wasn't really impacting.
No,
My
these
only
are-
conflict would be when we have a job where we buy a water meter or a fire service
Yeah.
from water and light. So I mean, I
And
end up
generally-
being a customer, so.
Right. And generally, these are generally applicable rules applied across our rate base. So we're not dealing with any particular single situation. So that's going to be the case for all the commissioners in terms of when we deal with rates or other generally applicable rules. You don't individually have conflicts in those situations.
I think Jody would be a good commissioner to have at this.
Yeah.
Her contacts and her information about things. So.
Okay. With that, I think I've reached the end of my rope.
So Tom, we're not going to let you off the hook. I think because of your history, you probably should be with Jody. Just my read.
I'm happy to do that if that's okay with the commission.
I mean, Scott, if you're okay with that.
Oh, absolutely. Okay.
Oh, I was just going to ask for a process. We're not meeting in person. Is that, would that be the case?
No, we haven't been meeting. I haven't met with anybody in person. My wife doesn't even want to be in the same room with me.
Do you need to find a good attorney, Sam?
Depending on if the COVID issue's over.
Yeah.
But if it's not over,
So-
we'll be meeting Zoom.
Okay, because I'm on a lockdown till the end of October, so.
So I will make a comment that I think a Zoom meeting would be great, but we have been, plowing this field for quite a few years that if we had to put this off, somebody give me a reason why we wouldn't put this off and have face-to-face for some of these folks. Some of the folks that we may want to talk to just maybe not be as technically proficient to hold some of these meetings. I'm concerned, and I'm gonna give you a parallel, and that is that there were some rate increases in the building department last year that had very little press or information put about in the community, and there were a lot of builders and subcontractors that were disappointed in that, and I don't want anybody to be disappointed in McMinnville Water and Light. So I mean, Zoom meetings are all we can do right now, but I think Tom could speak to the face-to-face thing sometimes makes it easier for these folks. But if we can't do it, we can't do it.
And on the other hand, if we can, I would like to keep this moving forward. Sam's been working hard on it.
Sure.
I'd like to have us, if we need to, and I think we would, have a Zoom meeting and then ask the people there whether they want to also have, whether they think they know people or would want to have a in-person meeting, put it off for a while.
Well, let me say this then, Tom. What we would need to do is have honestly, and if I'm stepping over my bounds, but Steve and Ryan know who they work with all the time, that they get a list together and staff we send letters and we send phone calls so that we can't be criticized for doing something in a vacuum.
Yeah, and we publicize it too. So
yes, yeah.
Plus we make these individual contacts. I think that's a really good customer relations thing.
Absolutely, we have to do it.
Plus staff gets to do it, not us, Ed. So that's good too, right?
Yeah.
Then let me share just kind of what we've done at the city. We're doing Zoom meetings, and we have the council that's on Zoom and staff, and anyone that wants to be a part of it. We're doing live YouTubes, just like we're doing right now. But we do set up Civic Hall, and we allow 10 people to come in there, and their social distances, and they can come up and use the mic if they have comments, and then we clean the mic after that. So that might be another way, is to have them come into the board meeting and just have 10 seats 6 feet apart, and if we can have the Zoom going up on the InFocus machine, and then if they want to have comments, we could do that. So you'd get both audiences, those that are tech savvy and those that aren't.
Well, let me just give you another parallel. Right now, the city's looking at a business license again. It's been being talked about. Jeff's talking about it, but very few people in the business community do it. I mean, I'm talking about having every customer we deal with contact it. And if it happens like the last time, nobody in the business community knew it was on the agenda, et cetera. And not to knock anything, but that was the reality. So I would say to Scott, then if you're gonna adopt a business license or want to talk about it, better send everybody that is in business a letter or something, you know. We just have a smaller constituency to deal with here.
Absolutely.
And we can also send out, that message electronically through Smart Hub too.
Yeah.
So we have a little bit more, I guess, way to reach people than just the city does. At least our.
Yeah.
And maybe ask the paper to publicize it too.
Yeah.
Maybe we have to buy an ad, to be honest with you.
Given their state of affairs, that may be correct. Okay, anything else, Sam and John?
No, I think that's it.
Commissioners?
Thank you all. Good meeting.
Sam, thanks for your patience. You are really a great person to work with. And if you'd like a letter of recommendation, Tom and I would each write one to your wife.
No, yeah, to your wife, but not to a different employer.
Yeah.
No, to his wife. Bye-bye. Bye-bye, everybody.
Thanks,
Guys.
Scott.
Hey, Patrick,
Yes, sir.
get some sunscreen on those legs before you go out swatting the white thing today.
I do that very well because I want to be safe. So.
Okay, I can show you all my scars.
Goodbye.
Thank you.